Blue Origin's $130 billion valuation risk compels business leaders to build a capital strategy and drive execution excellence. Did you know Blue Origin is shaking up the entire space economy by chasing a massive $10 billion fundraising round at a staggering $130 billion pre-money valuation? This massive transaction marks a historic turning point because it is the company's very first external fundraising round after more than 25 years of relying almost entirely on founder capital. You can see how serious this transition is when you realize Jeff Bezos himself is committing $2 billion, while Coatue is expected to anchor the round with an institutional investment of $4 billion. As you analyze this shift, you will see that private institutional funding is now absolutely essential for scaling massive launch infrastructure, satellite networks, and competitive lunar programs. This fundraising surge follows heightened investor enthusiasm after SpaceX's historic public listing, which established a massive benchmark market valuation between $1.75 trillion and $2 trillion. However, you must keep in mind that Blue Origin is securing this capital while still recovering from a recent, highly destructive New Glenn static hot-fire launchpad explosion. If you look at the broader landscape, the global space economy is expanding rapidly and is already valued at more than $600 billion today. Industry forecasts show this market is projected to approach a massive $1 trillion during the next decade through launch services, satellite communications, and space infrastructure. You should notice that government agencies are rapidly increasing investments in strategic space capabilities as intense geopolitical competition expands across low Earth orbit. To put things into perspective, the U.S. Space Force budget now exceeds $40 billion annually to support critical communication, navigation, and national security programs. Meanwhile, NASA's finalized FY 2026 enacted budget has reached $25.38 billion, demonstrating strong, continued strategic commitment despite broader global fiscal pressures. If you are tracking capital markets, you will see they are heavily rewarding companies that demonstrate long-duration technology platforms rather than near-term profitability. From your perspective as an investor, this $10 billion fundraising reflects a deep, structural transition in global asset allocation rather than a routine corporate financing event. Rising institutional demand for alternative assets is encouraging investors to allocate larger portions of portfolios toward technology sectors capable of generating multi-decade cash flows. You are seeing aerospace, artificial intelligence, cloud infrastructure, semiconductor manufacturing, and satellite communications actively compete for the exact same pools of institutional capital. Therefore, you must recognize that execution quality and operational milestones are becoming vastly more important to the market than flashy valuation headlines. Despite securing incredible investor confidence, Blue Origin faces measurable execution challenges that you cannot afford to ignore if you want to understand the market. The company has successfully won multi-billion-dollar NASA and U.S. Space Force contracts, yet it still trails SpaceX substantially in its recurring launch cadence and commercial revenue. This means investors are assigning a $130 billion value based almost entirely on expected future market position rather than present operating and financial performance. In this environment, L-Impact Solutions emphasizes that business leaders must distinguish between mere capital availability and flawless operational execution. When you raise $10 billion at a $130 billion valuation, you get significant financial flexibility, but it does not automatically increase your annual launch cadence. You cannot expect a pile of cash to instantly improve first flight success rates, shorten manufacturing lead times, or magically generate sustainable free cash flow. With Coatue investing $4 billion and Bezos contributing $2 billion, you need to realize that approximately $4 billion of this round still depends entirely on broad institutional investor confidence. A $130 billion valuation places Blue Origin among the world's most valuable private aerospace companies, despite it having a significantly smaller commercial operating history than leading incumbents. To justify this premium, you should expect to see measurable progress through 20 to 40 annual orbital launches and a launch reliability rate that consistently exceeds 98% to 99%. You will also need to track manufacturing productivity improvements of 25% to 40% and annual commercial revenue growth that holds steady above 30%. L-Impact Solutions warns that every single quarter, without meaningful operational milestones, increases valuation pressure because institutional investors benchmark companies against real return on invested capital. Another strategic concern you must evaluate is extreme revenue concentration, as Blue Origin remains heavily dependent on launch services and national security contracts. In contrast, diversified aerospace leaders generate predictable recurring income from satellite broadband, software platforms, cloud integration, and commercial communications. Industry data indicate that these recurring service revenues typically achieve gross margins that are 10 to 20 percentage points higher than hardware-focused businesses. You must also account for the macroeconomic environment, as global interest rates remain considerably higher than the near-zero rate environment that dominated capital markets between 2020 and 2021. Higher interest rates mean private equity firms, sovereign wealth funds managing over $13 trillion, and pension funds managing over $60 trillion expect extreme capital efficiency. L-Impact Solutions reminds you that every $1 billion invested is now heavily accountable for measurable productivity improvements rather than speculative corporate expansion. Capturing even a 5% share of a $1 trillion space market requires world-class manufacturing scalability, customer retention exceeding 90%, and incredibly resilient supply chains. Ultimately, your sustainable enterprise value will depend on converting that $10 billion of fresh capital into durable revenue growth and higher asset utilization. If you look at this through a pastel lens, you will see that space infrastructure is becoming a core component of future economic competitiveness rather than a niche technology sector. From a political standpoint, as geopolitical competition expands across low Earth orbit and lunar exploration, companies with scalable launch capabilities become critical national assets. Economically, a $10 billion capital injection generates thousands of high-value engineering jobs while creating a massive multiplier effect across global suppliers. Socially, you can see how expanding satellite infrastructure directly improves broadband connectivity and telemedicine for the 5.7 billion people who now use the internet globally. Technologically, this capital can accelerate your integration of reusable launch systems, digital twins, and autonomous operations to radically transform production. Did you know that digital engineering and automation can reduce your aerospace production costs by 20% to 35% and improve overall manufacturing productivity by 30% to 50%? This is an incredible opportunity when you consider that global artificial intelligence spending is expected to exceed $500 billion annually within the next few years. Environmentally, because environmental, social, and governance assets represent tens of trillions of dollars globally, your future capital access depends on demonstrating measurable sustainability. Legally, you must master national launch regulations, export controls, and orbital debris mitigation standards to protect your long-term enterprise value. L-Impact Solutions points out that future leadership in the global space economy depends on perfectly balancing political alignment, economic discipline, and regulatory excellence. To achieve this, you should allocate the $10 billion through milestone-based investment governance instead of deploying capital across multiple programs simultaneously. You should ensure that every single investment exceeding $250 million passes predefined technical readiness, commercial validation, and financial return reviews before receiving more cash. By using this strict stage-gate capital governance, you can frequently improve your capital productivity by 15% to 30% while reducing cost overruns. You should also accelerate your diversification into recurring revenue businesses, such as Project Sunrise with its 51,600 satellite data center network and TerraWave with its 5,408 satellite connectivity network. Increasing your recurring revenue to 40% to 50% of total sales over the next decade will materially improve your valuation resilience during economic slowdowns. If you make operational excellence your largest recipient of capital, you can use digital twins and robotics to reduce manufacturing costs by 20% to 35%. This operational focus will help you shorten production cycles by 25% to 40% and successfully scale your annual launch capacity into the 30 to 50 mission range. You can also look to expand your strategic partnerships into global enterprise technology spending, which already exceeds a massive $5 trillion annually. For your financial governance, you should publicly monitor a return on invested capital above 15% and annual revenue growth exceeding 25% to 30%. You must also push for an operating margin improvement of 300 to 500 basis points and a free cash flow conversion rate above 80%. L-Impact Solutions advises integrating engineering, finance, cybersecurity, and supply chain resilience into a unified governance framework to survive a landscape where global cybercrime damages are projected to exceed $15 trillion annually. To secure your supply chain, you should establish dual-source procurement for at least 80% of critical components that carry lead times exceeding 12 to 24 months. You should also make sure you maintain strategic inventories covering 6 to 12 months to completely protect your operations from geopolitical disruptions. When managing your human capital, you should proactively invest 3% to 5% of your annual payroll directly into intensive workforce development and technical certifications. Ultimately, if you want to define the next decade of the space economy, you must focus on converting every $1 billion of invested capital into higher productivity and durable cash generation. Can your capital strategy survive a $130 billion valuation without execution? Comment below. For more strategic analyses, visit our business consultancy website, link in the description below. Thank you.